5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to this very special episode of the Follow the Money podcast. My name is Jerry Robinson. Today's episode 494, we're entitling it Washington's Runaway Debt Machine. You know, I wrote a book called Bankruptcy of Our Nation many years ago, and we continue to see the same trajectory. Here we are in 2025. It's been 10 years, or actually 15 years or so, since I wrote that book originally. Wrote it back in 2008, so I guess it's been longer than that. And we just continue to see the debt spiraling out of control here in the United States. I don't have to tell you this. I mean, the numbers keep coming out of Washington. They just keep getting harder and harder to ignore. In fact, the latest piece of data that we got was the August numbers, the August spending, the August revenue for the federal government, and also the spending. The federal government ran a $345 billion with a B, $345 billion deficit in the month of August alone. That's 1 month in peacetime with low unemployment, at least relatively low unemployment. And it pushed our total deficit for this fiscal year to nearly $2 trillion. We only have 1 month left to go. So we look at that. Then, of course, we look at the interest on the national debt, which has now, of course, surpassed defense spending. Think about that we're paying more to service old debt than to defend the country right now. And then, of course, as rates stay elevated, that interest bill only grows bigger and bigger. And yet, if you look at the stock market, or even, quite frankly, the bond market, you'll notice that they're relatively calm. The stock market's trading at record highs or near record highs. And there's a reason for that. We're going to explore that today. By the way, today is Wednesday, the 17th of September. I'm recording this just before the Federal Reserve is widely expected to cut rates for the first time this year. And it will likely be the first of several cuts before the end of the year. I'll tell you more about my expectations as we get deeper in today's broadcast. But sitting in the background of all of this climbing debt, and the Federal Reserve getting ready to cut rates, what do we have in the background? We have around $7.5 trillion in cash parked in money market funds right now. It's an all-time record high. And the way I'm viewing that is it's really dry powder, right? When rates begin coming down, history suggests that money that is in money market funds like that isn't going to stay parked there for long. So we're going to talk about what that might mean for the markets. So in segment one, we're going to talk about Washington's runaway debt machine. We're going to talk about that August deficit. We're going to talk about the interest costs and how it's all connected to what the Fed is doing right now. And then in segment two, we're going to walk through some of the markets. I'll look at the S&P 500, the NASDAQ 100, the US dollar, Bitcoin, gold, silver. I'll give you a check-in on how our 2025 outlook has also performed so far year to date. And then finally, in segment three, we'll wrap it up with a few key takeaways and a final word about what all this means for us as we go forward. So kick back, settle in, and let's get started. All right, friends, so let's talk about what I'm calling Washington's runaway debt machine, because that's really what it's become. We don't really have a system of fiscal responsibility here in the United States. Definitely not in Washington. It is really out of control, and right now it's running hotter than ever. We just got the latest data from the Treasury Department in August alone, the month of August, 30 days, 31 days, whatever it is. The federal government spent $689 billion, and they brought in during that same time in total receipts $344 billion. So if you do the math, you're talking about a $345 billion hole in a single month. Now, to put that in perspective, that's about the size of the entire annual budget of many large states, all just simply poof, gone in 30 days, right? Now we've seen that the year-to-date deficit for the United States is sitting at nearly $2 trillion, $1.97 trillion. We're on pace to hit the third largest deficit in U.S. history, behind only the COVID stimulus years, 2020 and 2021. And remember, we don't have a pandemic right now. We're not currently engaged in some sort of world war right now. And on top of that, we're living in peacetime, relative peacetime. I mean, it's difficult to call what we see around the world right now peacetime, but you know what I mean. The United States is not engaged in a battle with Nazi Germany right now or trying to take down Imperial Japan, right? So relative peacetime and also relatively low unemployment. So right now, if we look at the data, Washington is borrowing over 40 cents for every dollar that it spends. You know, if you and I tried to run a household like that, I mean, we'd be bankrupt in months, right? We could never get away with it. And here's the part that is really alarming, is that you look in the month of August and you'll see that the government spent $93 billion on interest payments alone. $93 billion in a single month. That's about, $3 billion a day on interest on the national debt, right? And if you look at the national defense spending in the month of August, it was only $83 billion. So that means that taxpayers are now paying more to service old debts than to defend the country. I mean, that sounds a lot like the end of an empire, right? Where your interest costs begin to squeeze out even your defense costs, right? And as long as the interest rates stay high, well, that interest bill is just going to keep getting bigger and bigger and bigger, right? And so the debt is really growing like a cancer. The publicly held national debt is now at around $30 trillion. And then when you add in the U.S. debt held by foreign countries, that all adds up to, $37.5 trillion, right? It's simply incredible, the place that we've gotten to. The national debt, in fact, has risen by, around that $2 trillion just over the last 12 months. It's just exploding. Even if you just look at the last 2 months, since July 1st, our deficits have added around $634 billion to that national debt. Again, just since July 1st, right? That's just simply incredible. And that's not even including the deficit for the month of September, which we're still in. We're going to figure out what that is at the end of the month. And all of this, of course, is being fueled by programs that are basically on autopilot. So if you look, for example, at the amount that we spent on Medicare, obviously a very needed, system for those who have paid into it. Well, if you look at Medicare, you're going to see that Medicare costs in the month of August were about $141 billion, right? Social Security costs another $134 billion. That's more than all the income tax revenue collected in the month of August. Isn't that something? You take all the income tax revenue that was collected in the month of August, and that's not even enough to cover Medicare and Social Security. So the machine just keeps running with borrowed money. Now, we can obviously point to the tariff revenue. We've been hearing a lot about how the new tariff revenue is designed to be able to take care of many of these costs. And yes, if you look at the breakdown for receipts by source, you'll see that custom duties which is or the tariff revenue, in the month of August, hit a record high. And that record high was $30 billion, thanks to the new Liberation Day tariffs, right? And if you go back and you look, you'll see that in the past, tariff revenue was usually somewhere around $10 billion a month or so, usually a little more, sometimes a little less. So now we've been seeing it kind of climb, and we've seen it get up to around 30 billion now, which is a record amount. But here's the problem. Here's the thing. That $30 billion in tariff revenue that was paid by importers here in the United States to import from foreign countries. No foreign countries paid that $30 billion. All that was paid by importers here in the United States. And then, of course, passed on, very likely, much of it is passed on, like Walmart is doing, passing it on to customers who buy the goods. But here's the deal. You got $30 billion in tariff revenue in August, right? Sounds great. But just like I talked about earlier, that is like a drop in the bucket compared to what we spent. We had a $345 billion deficit in the month of August, and we have record tariff revenues of $30 billion in August. And so that simply covered less than 9% of the monthly deficit. So again, it's just a drop in the ocean, right? So even when Washington gets a win on revenue, it barely makes a dent in the outrageous amount of spending. Now, what's interesting is we don't really hear anybody talking about this, right? You don't really hear anybody on the left side of the political aisle talking about how we can't afford to run a government like this. You also really don't hear anybody on the right side of the aisle either talking about this. And this is what I've been saying for years, right? It's like a broken record. Like the point is that nobody cares about the amount of spending that we have until they're going to be forced to, right? We will face a reckoning on this. You can't do this forever. But right now we're living in some sort of, denial about what's actually happening, right? We're spending outrageous amounts of money and no one is really talking about it. And that brings us to the Federal Reserve, because as I mentioned, as I'm recording this, the Federal Reserve is meeting, the FOMC. They're going to be releasing their latest interest rate policy decision in the next few hours. The markets are pricing in a 96% chance, last time I looked, of a 25 basis point rate cut. I fully expect the Fed to cut by 25 basis points. It's very rare for the Federal Reserve to disappoint markets when the markets are so much expecting, a certain outcome. And the markets it's a 100% chance of a rate cut, 96% chance of a 25 basis point rate cut the last time I looked, a 4% chance of a 50 basis point rate cut. So either way, markets are expecting a rate cut. So if the Fed doesn't deliver, I would suggest to you that the markets could go down. There might be that might shock the markets, and you might see a move down in the markets. If the Fed cuts by 25 basis points, you may get a rally. But at the same time, it's already kind of baked in. So again, you're almost expecting kind of a buy the rumor, sell the news. We've been anticipating a rate cut now for so long, all year long, right? That it's almost just baked into the cake. So to think that the market's going to rally big because of a 25 basis point rate cut that it's already expected, I just don't see that initially. Although you could certainly get an ensuing rally as we head into Q4. Much of it's really going to depend upon the language that Jerome Powell uses as he delivers the news, and certainly how he answers questions. Because the big question marks will be, okay, if we get the 25 basis point cut today, the bigger question is going to be, what about October and December? Of course, there's no meeting in November, but there is one at the end of October, and there is one in the early part of December. So the questions will really be, what about the next few months? Now, the Fed could always hold a meeting in November and announce a emergency rate cut if it needed to. But it's more likely that if it feels like it needs to do that, it might do a larger cut, say in October, to kind of cover that month as well. The point being is that the questions are going to be, what about the future? What about next year? How many cuts should be expected next year? And those are going to be the kinds of questions that could really shift the market or cause it to move, because the market is always looking forward, right? It's a forward-looking device, if you will. And so what it expects could really affect the price right here in the here and now, what it expects in the future. So the Fed is trying to balance the rising inflation, which, by the way, CPI came in the month of August at 2.9% year over year. That was a little hotter than analysts were expecting. It's certainly the highest print we've seen since January of this year, when it was at 3%. So we're certainly moving higher now with inflation. So the Fed's trying to balance that with this softening labor market. The labor market really is not in a terrible place. It's just, the best word I can use to describe the labor market from my perspective is that it just appears to be frozen. It appears to be very stagnant. There's just not a lot of movement. We're not getting tons and tons and tons of layoffs, although there have been layoffs. We're just not seeing, a whole lot of growth. That's really the thing. And so the Fed obviously wants to see stable unemployment, has a dual mandate: stable unemployment and stable prices, right? Stable prices and stable employment. This is the dual mandate for the Fed. So they're not going to be cutting because the economy is booming. That's not really why they're going to cut. They're not cutting because the system is starting to creak under the weight of all the debt. That's not really why they're cutting. But if they don't bring rates down, then that $93 billion interest bill that we paid in the month of August is going to continue to get bigger. And the machine could slowly start to seize up. So certainly the Fed does need to cut interest rates if the government doesn't want to be completely swallowed up in interest payments over, the coming years. So this is interesting, though. In all of the background of this, kind of sitting in the background, is $7.5 trillion parked in money market funds. Now, that mountain of cash didn't just appear overnight, of course. It built up after the Fed's extremely aggressive rate hikes back in 2022. You may remember that back in 2020 and 2021, there was this enormous amount of spending and money printing, right? Checks being mailed out to you, and all of this, and loans being given that, many people didn't have to pay back. And so there was an extreme reaction by the federal government to the pandemic economically, relative to, if you look at, say, China, for example. China didn't even really cut rates during the pandemic. Others reacted different. The United States went extreme, right? But it happened to be an election year as well. 2020 was an election year, so it made sense that checks were being mailed out to you, and there was a lot of politicking going on during that time. So, when we look at it, we say, well, the Fed began to raise interest rates because all of that inflation, and they raise interest rates, and what does that do? Well, investors pulled money out of risk assets. The market was going down in 2022. Remember that. It's a brutal bear market. And they began to pile money into risk-free, vehicles like money markets to grab that yield, right? So we got interest rates up pretty high back in 2022. And investors just simply moved to the risk-free assets of money markets. So historically, the normal level for money markets, at least in our recent times, is around $3 to $4 trillion. So having $7.5 trillion locked up in money markets is really unprecedented. It's been good for credit unions and for banks to have all of this excess money in the money markets. But when the rates begin to come down, which we believe that's going to begin today, right? We're going to begin a rate cutting campaign we're going to see over the next several months. Well, as rates come down, what does that mean? What does that mean for that $7.5 trillion cash pile that's sitting in money markets? Well, history says that cash is going to start looking for a new home, right? Because as rates come down, the money market rate's going to come down as well, and it's just not nearly as attractive. So we could see all this money on the sidelines that's sitting in cash, a lot of nervous Nellies on the sidelines, even as the markets are at new all-time highs. But eventually, as the rates come down, you could see them begin to move back into. In fact, you could even build the case that they might start to flood back into equities or crypto or metals or even real estate, especially if we get a drawdown in real estate prices. We're already starting to see, prices come down in many different markets, but it could even accelerate if things, don't improve soon. So anywhere with yield or growth could attract that money that's sitting in money markets now, and that money won't sit there forever, right? It'll get back to the natural rate of $3 to $4 trillion. So we really are in an unprecedented time with cash on the sidelines. So let's just zoom out here. We've got runaway deficits, right? Soaring interest costs, and a Fed that's really cornered. It's going to have to cut rates. And on top of all that, we got $7.5 trillion just waiting to move. That's the setup. And if the Fed does cut today, which I expect it to do, it could be the spark that lights that fuse. So we do expect to see over the next 12 to 18 months, more and more cash that's sitting on the sidelines in terms of money markets, CDs, things like that, to come back into more risk assets. And that, of course, could drive up, along with rate cuts and the expansion of M2 money supply, that could certainly drive up asset prices. So with that in mind, let's step back and look at the markets. We'll see how they're positioning as this story unfolds. I'll dive into my market commentary right after this break. Hold tight. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, let's shift gears and zoom in on the markets, because while Washington's out-of-control runaway debt machine is running hot, the market's reaction has been surprisingly calm. And honestly, that's not really too surprising to me. In fact, back in January, I laid out and shared my 2025 market outlook with our members. And then you may recall back in episode number 477, I encourage you to go back and check it out if you missed it, but it was called 2025 Market Outlook, and we laid out a few of the key themes that we were targeting for 2025 based on what we expected to work out and actually beat the S&P 500. So as we get ready to wrap up the third quarter here, I just wanted to check in on how it's doing, and then I'll also provide some basic market insights and cover a few charts. Let's begin with our 2025 forecast scorecard. A lot of the key themes that we laid out earlier this year have really been playing out well. First, the U.S. dollar has weakened right on cue. We had mentioned that we expected the dollar to decline in 2025. That was one of our core calls, and it's helped fuel strength and risk assets this year. So part of the reason why we've been seeing stocks go up, gold and silver go up, everything going up, is been due to that weaker dollar, right? We also said that we expected corporate earnings to surprise to the upside, and they have. Many companies have beaten expectations despite the higher rate environment, which has definitely supported equity valuations this year. On the sector side, technology has led the way, especially AI and cloud names inside the NASDAQ 100. That's been one of the strongest performers this year. That was one of the markets we expected to beat. The S&P, we expected tech, communication sector, AI, the NASDAQ 100. We expected all of these to beat the S&P 500 so far. So good. We also have seen crypto roar back to life over the last year or so. We've seen gold and silver surging, and even cannabis stocks. All of these we had said in our 2025 market outlook that we expected to outperform the S&P 500, and they all have outperformed the broader market year to date. And so that's, it looks pretty good. I mean, overall, everything's looking good. I think there's a couple of themes that we suggested that have kind of lagged a little bit. Small caps, for example, not quite beating the S&P 500 yet, but they're certainly moving in the right direction. I think the rate cut's going to help them cross the finish line by the end of the year. I suspect that small caps will outperform the S&P by year's end. Also, financials, the financial sector, I'd expected to do a little bit better than it has this year, but it hasn't really broken out as well as I had expected it to yet. But again, I think with rate cuts, we could see that happen as we head into the end of the year. But overall, this outlook that we put out in January has held up extremely well as we near the close of Q3. Our members can go back and download the whole thing. We did a whole hour-long video on our economic and market outlook. And for those who are not members, you can go back and listen to episode 477 where we laid out some of those key ideas. It's a pretty interesting podcast episode. Now, let's do a market rundown here. Let's run through some of the major markets before we bring this segment to a close. We'll begin with the S&P 500, which hit a new all-time high this week, still holding strong. We've seen some choppiness, but really no breakdown. In fact, when you look at the S&P 500, since its 200-day moving average breakout back in early May, it has not pulled back to its 50-day moving average even once. It got close in August, but it didn't touch it. So this is, 1, 2, 3, 4, we're going on 5 months now of no pullback to the 50-day moving average, which is pretty rare. You don't tend to see that too often. If you look at the percentage of stocks in the S&P 500 trading above their 200-day moving average, that's about 63, 64%, somewhere in there right now. So again, that's bullish, not suggesting that we're overheated. When we turn to the NASDAQ 100, it's really been leading the charge. It's outperforming the S&P 500. The big AI names continue to drive momentum there. And as long as earnings stay firm, that trend is likely to have more room to run. Speaking of the NASDAQ 100 QQQ, since its May breakout in the 200-day moving average, it has recently pulled back to its 50-day moving average in August. And that was the first touch of the 50-day moving average since the May 200-day breakout. After that touch, we got a nice bounce. That was the first 50 SMA bounce, and we've since moved on to a new record high. So the NASDAQ also very well, having a great year so far, year to date, right? Obviously beating the S&P 500. Now, when we turn to gold, we'll see that gold is also really having a great year. In fact, it's enjoying its very best year since 1979. I mean, you have to go back to the Carter years to see gold having a better year. It was 1979, the last time we've seen this kind of gain in gold. Here's a quick quote from the Wall Street Journal. It says, gold's value has ballooned by 39% this year. That was as of a few days ago, putting it on track for a greater annual price jump than during the depths of the COVID-19 pandemic or the 2007 to 2009 recession, according to Dow Jones market data. Futures for the precious metal haven't surged so much in a year since 1979, when a global energy crisis fueled an inflationary shock that thrashed the world's economy, right? So this historic rally in gold isn't coming from a financial crisis like 2008 or 2020. Instead, it's being driven by outrageous debt-fueled spending and, of course, that chaos premium that often follows President Trump's decisions on tariffs and trade. So we've seen central banks loading up on gold. We've seen Chinese investors accumulating gold for years. But this year, U.S. investors really joined in aggressively. We've seen, for example, holdings in U.S. gold-backed ETFs have jumped over 40% since January. So, that plus the fact that the U.S. dollar has been rapidly weakening and the Fed is expected to cut rates today, right? Well, that's going to serve to lower the opportunity cost of holding gold. And I expect it will probably even add more momentum to the gold trade, particularly in the gold mining space. Gold is really, really, really overbought on the monthly chart. Doesn't mean it can't go higher. I mean, believe me, it can. But just realize that if you're looking for, more upside in the precious metal space, you're more likely going to find it in silver. You're more likely going to find it in platinum, because gold has already had this incredible rally. You got to remember back at the beginning of 2024, gold was around $2,000, right? And that was, that's less than 2 years ago. And now we're at $3,700 or so per ounce. So that's a radical move, right? We haven't seen that kind of move in some time. Like I said, 1979, to see that kind of a rally in such a short amount of time. Also, the U.S. dollar just continues to drift lower, which really lines up with our 2025 forecast. That weaker dollar, as I mentioned, tends to be bullish for global equities, commodities, U.S. multinational companies. And so this is really a tailwind, not a headwind for the markets. And the U.S. dollar now is just trading really near its low for the year. And aside from that, the lowest it's been since early 2022. So the dollar obviously running into some problems there. When we take a look at China, one of the markets we also expected to do well in 2025, and we listed it in our market outlook, was China. China so far this year has been on fire. The S&P China ETF, for example, GXC, up nearly 40% year to date, right? Compare that to the S&P, which is up like 12% or so, 10, 12%. So, I mean, that's obviously a huge difference. So China is practically quadrupling now the S&P 500 year to date. So their stocks have been on fire. Alibaba, one of our favorites, just running strong right now. If you look at silver, silver is also at a 14-year high. Honestly, silver has really been the standout. Out of the 10 markets that we track in our Robinson report each weekend for our members, silver has moved to the top in terms of year-to-date gains. So it's really led the way. It's outpaced gold's gains this year. And I think it still has significant upside potential, especially if this rotation out of cash picks up speed with lower rates. So silver looking really good. It's still sitting below its all-time high of around $50 that was hit back in 2011. But it's currently trading, above $42. That, again, very impressive for silver to be sitting, at those levels. Let me also briefly talk about Bitcoin, because we've talked about pretty much every other major market that I want to talk about for this segment. But let me just also chime in on Bitcoin for a minute. Bitcoin sitting at about 115,000 as we record this. Ethereum sitting at about 4,500 as we record this. Both of these, of course, we think are winners, longer terms, as well as Solana, as well as Chainlink, as well as several others that we really do like and own and have owned for many years and continue to buy. We think that Bitcoin is, we're going to see a resurgence here, very likely in the wake of the rate cut, but also especially as we enter Q4. We expect that we're going to see some big moves there. Also in Ethereum as well. Most of the areas that we're watching right now, for example, on Ethereum would be the $4,000 level. That's key support right now for Ethereum. When it comes to Bitcoin, right now the key area we're watching is that 200-day moving average, which is currently about 103,000 or so. I don't see Bitcoin pulling back to that necessarily. We could get that if the markets don't like what they hear from the Fed today. You could get an overall rout. If that happens, I'm probably going to take advantage of any kind of pullback and add to my long-term holdings. Again, I'm not really expecting too much movement in the wake of the Fed announcement. But again, you know how the markets can get jittery. And if Jerome Powell says something wrong, which he really doesn't do very often, he's pretty smooth on his delivery. But if something goes wrong and the market takes it the wrong way or whatever, then you could get a pretty sizable pullback. And if that happens, I'm not saying it's going to, but if it happens, I'm probably going to jump in and add to some of my longer term holdings because I do want an opportunity to buy any kind of dips here. I think we're going to continue to see strength into Q4 for the broader markets as well as for some of the digital asset markets. So, and all of this, of course, ties back to what we've been talking about in segment one, that $7.5 trillion sitting idle in money markets. That market, it, of course, is way overstretched. That's very unusual for us to see that much in money markets. And the market's already positioning for it. You can feel it in the tape. As soon as the Fed confirms that first cut, we can begin to slowly see capital begin to rotate out of some of these money markets and to get into risk assets, which typically go up in times of a rate cutting environment. Usually not at the beginning of the rate cutting environment. Again, usually because when the Fed cuts rates, it's because the economy is anemic or whatever. But overall, we think that these rate cuts are going to spur even more demand for risk assets. And the assets that benefit the most are often the ones that were already showing relative strength, like the ones we've already talked about. So that's where we stand as Q3 comes to a close. The market's holding up. Our 2025 outlook has largely been on target, and the stage is set for a potential surge of capital as the Fed begins to ease interest rates from their current levels. So let's wrap all of this up in segment 3 with a few big picture takeaways. I want to leave you with one final thought on what all of this really means, and I'll see you on the other side of this quick break. All right, friends, welcome back to the final moments of today's broadcast. Let's bring this episode home. We've covered a lot today, and if there's one word that sums it all up, it's this: unsustainable. Washington is spending money it doesn't have. It's borrowing over 40 cents on every dollar that it spends, and it's now paying more in interest on old debt than it spends on national defense. Right? The national debt just keeps climbing. It's $37 trillion. Before you know it, it'll be $40 trillion. We have Medicare, Medicaid, Social Security programs that are crowding out investment in other things that we need: infrastructure, education, on and on and on. And the Fed is cornered, right? It's trying to hold inflation down while also keeping the whole system from cracking underneath its own weight. It's dealing with out of control fiscal spending. And it really is. It's just simply cornered. And while all of this plays out, about that $7.5 trillion in cash is sitting on the sidelines, quietly waiting for a signal from the Fed that it's safe to come back into risk assets. That's the backdrop here, right? And if the Fed begins cutting rates, as we expect today, we could see a pretty big wave of capital rotation out of cash and back into equities, back into digital assets, back into metals, back into other risk assets. So let me leave you with this final word. This time, not a quote, just a thought, that cash feels safe until it isn't. And a lot of people have learned this the hard way throughout these centuries, especially over the last couple of centuries where we had so much hyperinflation through poor monetary and fiscal policies. that cash will sit there quietly. It makes us feel protected, but while it's sitting there, it's really quietly being debased. The dollar is losing purchasing power. The dollar index, by the way, is down around 10% this year alone. Over the last 9 months, the US dollar index has fallen 10%, right? So the dollar is losing purchasing power, the national debt keeps climbing, and the system is quietly shifting underneath our feet. You see, real safety when it comes to your finances really doesn't come from hiding in cash that's being debased, right? It comes from being positioned ahead of where the capital is going next. And that's what we try to do here. We don't chase every move, but we understand the flows and we get there first, patiently and strategically. So my advice as we head into the remainder of this year, and especially as we head into this Fed meeting that's so closely watched, is to keep your eyes on that Fed. Keep watching the flow of money and where it's going. Remember, in a system built upon debt, staying in cash and just sitting there is rarely safe, right? It's important to have a diversified investment strategy, and I encourage you to do that. If you need help getting that started, go over to our website, followthemoney.com/5 levels. There we lay out the 5 levels of financial freedom that we have used to break free financially, and it's the same thing that we teach all of our members. So I want to thank you for tuning in today, my friends. If you enjoyed this episode, be sure to subscribe, share it with a friend. And as always, I encourage you to keep following the money. And until next time, my friends, have a prosperous week, and we'll see you right back here next time. Take care, and God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.